Welcome to the People Property Plays podcast. My name is Mathieu Elshout. I'm your host, and it is great that you are here. Today, I'm thrilled to be joined by Mathieu Elshout, Head of European Property at Aware Super, where we're going to be unpacking his background journey, Aware Super, also his views on the market. So it gives me great pleasure that he joins me here today. So welcome to the show.
Happy to be here. Thanks for having me.
Not at all. Well, look, I'm really excited to understand a little bit about your background journey and how you see things, as I discussed. But before we get on to some of that good stuff, can you tell me about how and why you got into real estate in the first place?
Right. I nearly didn't, I'd say, first of all. Maybe it's a bit of a long story to that, but I did get into real estate eventually. But I actually started off when I had to choose, what to study. And I didn't choose real estate or economics or whatsoever, but environmental sciences. And my parents advised against it. They thought I was just copying my older brother. And maybe they were right, but I didn't think of it like that at the time. My uncle, he owned and had been growing a large construction company, and he also advised against it. But still, I was convinced I had to get into environmental sciences. So I obtained my bachelor in environmental sciences. This is in the 90s, right?
Well ahead of the kind of ESG and green agenda.
Definitely ahead of that agenda in real estate. Yes, for sure. And I obtained my bachelor on a specific subject. That my thesis was about the sustainable development or redevelopment of industrial areas, which was very new at the time as well. You can see already a link to real estate development, perhaps. I wasn't focused on that at all. The sustainability was my angle, and I started off with a consulting engineering company at the time in 97 as a consultant with the company Grondmij in the Netherlands, now Sweco, with my environmental sciences background.
Why environmental science? Why did you want to do that?
It felt like the right thing to do. It had a combination of, aspects that I really liked. I had, this focus on sciences was with me, yes, but also other aspects. I've been a Boy Scout in the past. As a young boy, I was with the Boy Scouts. I was always attracted by nature as well, the environment and in general. So for me, it all made sense. And I had a great period, for sure, for the 4 years. And consultancy was also fantastic to be with a consultancy firm for 10 years, actually. Really enjoyed that.
But during that time, you weren't exposed to real estate. You didn't want to get into real estate. Well, it was kind of ancillary, or
no, that definitely happened during that period. In my first 2 years, it was really focused on advising, mostly municipalities on how to develop in a sustainable way, redevelop an existing industrial area or develop a completely new industrial area, which basically is about, don't just put buildings on in such a zone, but also ensure that these companies are working together so they benefit from each other's presence. So design it in such a way and bring companies together in such a way that there is a sustainability benefit as well. Now, after 2 years, working from different offices, different locations, I did recognize, okay, there is more. And I already saw people in the real estate sector within this consultancy that I thought, okay, that's quite interesting what they are doing. But there was a slight delay, though, for me before I really got into real estate, because it was the time of telecom as well. I didn't know we were approaching a boom, but we were definitely in this bubble of telecom. So I took on a direction after a couple of years within this company and started working on projects in telecom. It was only for 2 years. It lasted only for 2 years before that bubble bursted. But I learned from that period of time what it is like to really take on big assignments as a consultant, with also turnkey delivering of projects. So not a real estate project, but definitely a real asset infrastructure as we know it today in glass fiber. So getting a ring around Amsterdam as an example of glass fiber to get it installed within a limited amount of time, pushing your contractors, negotiating with the contractors, negotiating with the client, of course, and delivering on these projects. So got me closer to real estate already during that period of time.
So if I'm not mistaken, after the telecoms experience, that's when you moved into real estate.
Yeah, so this was in the early 00s. I moved into real estate indeed. So finally, it got me across the line. I started off with another department within the consultancy firm, still the same firm. I was moving around, finding my way up in the organization, but also changing from the one sector to the other sector. So I started leading a team in real estate project management, so real projects, building new offices and other projects as well, leading the project management team in that part of the company. I did it for almost 4 years, learned, a lot more about the construction period, but also learned that development sometimes takes quite a long time. And I felt that, developments could take too long for me. So I decided to move on and again, shift into a slightly different, the investment side of the real estate. We had a small department within the firm as well, who were advising smaller to medium-sized pension funds within the Netherlands on their real estate and infrastructure portfolio. And I was fascinated by this whole new industry that I didn't know about. I was really used to the really hardcore real estate and advisory consultancy. And this was, more sophisticated, more suits as well, I would say. And it intrigued me. I started with this group. We started advising, and I really brought more the hardcore knowledge of real estate at the time. Also recognized I needed more in real estate. I needed more knowledge. So I started my master's in real estate when I was with this consultancy group within Gondmai.
So what was it specifically about real estate that you really enjoyed in comparison to kind of the other sectors?
Even walking up here, right, from my office to yours, I find it intriguing to see the beautiful buildings, and they last for long, and the present. And whenever I'm walking through a building and people show me around, I find myself, and my children would probably confirm it, you find me knocking on walls and just, the materials, that it's tangible. I love it. I love to see how we build them, how we maintain them, how we try to redevelop them, try to make sure that they last for as long as we can. So I've always been passionate in a way about real estate. I just didn't know I was going to be working in the real estate industry.
Did you enjoy the real estate investment part of your role as much as you thought you would?
More and more and more over time. Although I did my master's in real estate, so that definitely made me more passionate about other parts of real estate that I wasn't so familiar with. But what makes me passionate really about it is that I can combine all the different aspects. Now, of course, and that's also the beauty of real estate investing. You combine not just the knowledge, hopefully, of a building and what it takes to build it and what it takes to maintain it, but also the investment side of it. But also there's tax aspects to any building, there's legal aspects to any building. So it brings together so many disciplines, which makes it fascinating. And I like to know a lot about a lot of things. So it doesn't make you necessarily a specialist, but I just sense there's so much to it I like to learn more about.
Satisfies your curiosity.
Yeah, definitely. Yeah,
and there's always something else. There's always something else to learn or look at.
It's fascinating.
Another piece to fit together.
Yeah.
So you moved to PGGM Investments.
Well done. Yeah. I was asked to join PGGM, and I remember so that was a great step up from consultancy
Yeah.
to the other side of the table as well, to really join an investor, and not just an investor. PGGM, the number 2 of the Netherlands in size, but also in terms of the platform they manage. So a great way to advance my career. I remember my first interview with the company as well. The then CIO, he invited me into his room, and he told me, well, let's come over to the window first and have a look outside. Well, I had a look outside, and I was witnessing a huge construction site. And he asked me, what do you see? Well, a huge construction site, for sure. And what do you think of it? Well, I was a bit struck, but because everybody who knows PGGM and has ever visited this office, it's in a bit of a strange location. It's in a small town close to Utrecht, in the heart of the Netherlands. You feel, if you follow the directions, you are driving into the wrong direction, because you're in a neighborhood, very residential area, and all of a sudden there's the PGGM office. It's sort of a campus with only one company on it. Beautiful location, but not, very office-like, not a business district or whatsoever. So I was looking on this site. I saw clearly something in the making, which had 3 floors for a parking garage only, and then probably an office would come on top of it. So I told him, it strikes me as a rather strange location to build something like this big. Wouldn't be an investment for me. And he said, excellent, let's start the interview. So I was relieved that it was apparently the right answer at the time.
And it wasn't him investing his capital in it.
Yeah, and maybe, the idea wasn't his either, probably.
And did it transpire to be a good investment or not?
I enjoyed being in it, for sure, and I'm pretty sure a lot of staff have enjoyed it as well. I do know that PGGM is going to move away from this area to a more centrally located and even better connected place. So, and that all makes sense, I guess. But that's with a lot of things with hindsight. It was all fine. I enjoyed my time. I've been with PGGM for over 12 years at that specific location.
So what role did you go in to do initially at PGGM?
I straight away started off within their European team. So I had a responsibility over a private real estate portfolio within Europe. It was a shared responsibility managing the European portfolio at the time. We had 3 different teams managing the different portfolios. So we had an Americas team, a European team, and an Asia Pacific team, all based in the Netherlands, managing the European or the global private real estate portfolio of PGGM.
So you're responsible for kind of managing a portion of that.
Yeah, indeed.
And how did your progression kind of evolve over the kind of the 12 years you were with the business?
Well, what was really interesting is that I joined in the summer of 2008, not long before Lehman Brothers went bust. So I was only a few months in my new role, and the shit hit the fan. And that was a really interesting time, of course, to be managing a real estate portfolio. Issues popped up in the portfolio. So we had to manage and crisis manage the portfolio. So lots of lessons learned through that process, trying to ensure that we could hold on to the assets we were invested in. So dealing with fund managers, GPs, trying to prevent banks from, trying to get hold of the assets, refinancing, negotiate, new loans with banks on different terms. So all of a sudden we were exposed to risks that, maybe we weren't aware of before. So a lot of lessons for many, of course, learned during the GFC. What was also really exciting was that during the process of crisis managing, we also recognized, okay, but if this comes to an end, it will have to come to an end, the crisis, there will be an opportunity. So when will the opportunities arise, and how can we make sure that we also benefit from the opportunities, not just only take losses, but also are able to invest in time to really benefit from the upside as well. And we did.
By selling or kind of working out situations?
Working out situations, for sure. That's more protecting the existing portfolio, but then also recognizing, okay, where would the recovery start first? And of course, this is a long time ago, right? It makes me feel old already. But we within Europe and also US, we also saw a difference. US took the pain immediately. UK in Europe was also very quick to come down, but also we suspected would be quick in its recovery as well. So we try to indeed invest in, I remember one of the first UK investments we really took on was invest more in what we already owned, and other LPs were in more of a liquidity squeeze maybe than us. So we were able to inject more equity into structures at very attractive terms, and then started to invest in retail again, for example, because that was really punished a lot, and started investing more, and that had a great recovery in the years after, and that was before the rents came down, by the way. So yeah, we had some early examples where we could benefit, also within on the continent in logistics, where we were early to commit to existing portfolios where, they had come to the bottom, were bottoming out, and we were early to invest in these sectors as well. Same for Dutch offices. I remember it took a lot of courage, and this was not already in 9 or 10. It took longer, right? This was more like in 12, 13, where we started to invest again in Dutch offices, and it was a great recovery of that sector.
And in terms of your kind of experience then, it was everything from kind of transactions, dispositions, asset management, portfolio management, financing. That's kind of really where you had a broad brush schooling experience, sector and geographical spread as well.
Yeah, we didn't feel we had to specialize in sector or geographies within Europe, say, and maybe different for different investors. But we felt as a team we needed to have, of course, we had to share the load, but didn't want to split between transactions and asset management. We really believed, and I still believe, it's important. You're not able to only do a transaction, but you're able to manage it throughout the life. You have to carry the whole responsibility and have the whole burden, or celebrate during the life as well. But not just transaction and asset management is with one person or with the whole team. And also sector-wise, we all managed a diverse portfolio within Europe. I think that is helpful.
Why did you decide to leave there and join Patrizia?
Well, I had a great time for over 12 years. At the time, we also moved from more fund investments into joint ventures, partnerships. So PGGM had evolved from being a direct investor up until in the 90s, becoming an indirect investor. Was very early to adopt the indirect investment model. And then from funds starting to invest more through partnerships, joint ventures, and having more direct control over their investments again was a fascinating journey for me. But after over 12 years, yes, I was looking for a new opportunity, a new challenge to continue to challenge myself as well. So moving to another side of the table for me was a new challenge to be moving to the GP side.
Yeah, and I guess satisfying your curiosity
again.
And moving kind of to the GP side. And if I'm not mistaken, you had a kind of sustainability remit, but also an impact investing remit as well. So is that a kind of a culmination of your early career experience and interest combined with the PGGM experience as well?
Yeah, and maybe I didn't realize it myself at the time, but during my PGGM tenure, I was also leading in the field of sustainability within the real estate team. So I didn't have anything like a title referring to sustainability or whatsoever. No. And I really liked it that way as well. I was a senior investment director within the PGGM team, and I happened to lead on the sustainability efforts, meaning I wanted to make sure that it was really embedded, so that as a private real estate team, we all believed in it. We all had to believe that sustainability pays off, and we're trying to improve the sustainability portfolio performance alongside its financial performance. And we truly believed in that, and we were able to make a difference in that sense as well. So I started from the investor side. I was one of the investors that initiated GRESB in 2009. So we all know GRESB today. It dates back to 2009 when a few investors, APG, PGGM, and USS at the time from the UK, these were the three investors that started, together with the University of Maastricht, started GRESB. Now, I've been with GRESB throughout my career almost. So yes, sustainability was with me. Later on within PGGM, we initiated, together with APG again, we initiated CREM, the Carbon Risk Real Estate Monitor, and have in that sense always been involved on the sustainability side, but it wasn't in a way in my title. But then Patrizia approached me and offered me this role to have the full responsibility over sustainability, the sustainability strategy within Patrizia, as well as their impact investing strategy. So have the responsibility to really build the impact investing capabilities within Patrizia. And for me, that combination of still having a responsibility over part of the investment side, as well as leading on the sustainability side, that got me across the line, and also moving from the LP to the GP side. So I had already been in consultancy, then moving to the LP side, and now moving to the GP side. I thought that was a great new challenge.
So from consultancy to kind of capital allocator to manager, it was a way to kind of round off your experience in a different environment or structure. For someone listening to this who isn't, or who doesn't know what impact investing means, can you just unpack that? And just like, what is impact investing? Where does that fit into real estate? And what are the outcomes you're looking to achieve?
So you're looking to achieve more than just a financial return. You believe there's more to be gained in that sense by focusing and trying to achieve environmental goals and social goals at the same time. I think the easiest example probably is invest in affordable housing. It's not just about generating return, but it does come with a financial and a risk-adjusted, a very attractive return as well, or it can come with such return. But you also feel you're delivering on the social side, in the sense the much needed affordable homes you're delivering on by really taking on these developments. So it's not about buying existing stock. No, it's ensuring that it's really built so that we add new homes to the market. Environmentally, also, you want to make sure that these homes are built to the highest standards, so you reduce the energy bill for your tenants. So that's a clear example, I would say, of impact investing. And I would say, if you put it in the perspective of time, I think we had a period of time where, in say the late 90s, there was a focus on responsible investing that advanced into really sustainable investing as well. So a focus on sustainability and integrating ESG within your investment strategy. And that is now followed by impact investing, I would say, another dimension, say a third lens through which you use when investing.
Having worked on the consultancy side, LP and capital allocation side, and obviously we'll come on to Aware Super, and then kind of the GP side at Patrizia, what are some of the kind of the differences or mindset shifts, having kind of worked in those three different types of environments and business models?
Well, it definitely makes you more rounded, I'd say. You start to appreciate the other side, as you will. it makes you more knowledgeable, I would say, a better understanding. Also, say language-wise, right? Not in the real language, but understanding the other side of the table better is definitely a big plus, I would say. I remember when I announced that I was going to leave PGGM, some of the colleagues said to me, "Oh, you're going to move to the dark side." Well, it's not a dark side, really. I've experienced there's a lot of people out there with a lot of good intent, whether it's on the LP side or in the GP side. But having been with consultancy, I appreciate the consultants. I know, they run and they have to run. And every now and then also feel sorry definitely for the engineers within consultancy. And I've been with them for such a long time. And we had this, we realized that we were running consultancy on such low margins that we could always concluded, well, actually on the Friday afternoon after 12 o'clock, we start to earn some money. That's really, so thin the margins are. So, we really had to do our best still on the Friday afternoon because we were making some money finally at the end of the week. And of course, you've got different consultants everywhere. But I really appreciate the knowledge they bring to the projects, and we need them in real estate as well.
Yeah, I guess how everyone fits in together, align incentives, and get the benefit out of all parts of it.
Yeah.
So a few years ago, Aware Super announced that they were coming to the UK.
Yeah.
Talk to me about the move there, the reasonings for kind of going from the GP side back to the LP side, and why ultimately you decided to join them.
Yeah. So maybe it was a bit soon, I had been with Guanmai for 10 years and then over 12 years with PGGM. And I was with Patrizia only for 3.5 years. I was enjoying it still. But the opportunity came, and I thought it was a rare opportunity of a new LP coming to Europe from Australia, knowing that the Australian super industry is definitely a growing industry. They offered me the opportunity to build a team and to really build and expand their current portfolio. I thought, well, it's not maybe the right time, but such an opportunity doesn't come by every day. So I took the opportunity.
So for someone listening to this who isn't aware of Aware Super,
Yeah.
Who are they? What do they do? And yeah, give me a little bit of background.
Yeah. Okay. So a super is a pension fund. It's just the Australian name for the pension fund, right? And of course, it's a different maybe setup as compared to other pension funds elsewhere, but it is a really sophisticated one as well. So every a person in Australia having a job would participate in a super and contribute to the super. Now, if you add all the supers together, it's very much a growing industry. There's a slightly younger population if you compare it to other countries. They make a huge contribution. They're obliged to contribute to their pension fund, to their super. And the combination of the younger demography as well as the growth and the obligation to pay into their supers makes it a really growing industry. If you compare to, say, the Dutch pension fund industry or the Canadians, they're much bigger today, but the Canadian or the Australians are projected to overtake the Canadians, for example, in terms of size. So it's growing, and Aware Super is the third largest super of Australia. Like some of the other supers, they of course had a property portfolio, as they call it. I prefer to call it real estate, but it's property for the Australians. Of course, they had been managing a property portfolio for a long period of time already. In the early days, they invested through funds, only Australia. and had only, just started to diversify away from Australia. And that's something, of course, we've seen with other industries elsewhere, whether it's Canada or the Dutch pension fund industry. There was this need to diversify away because there's so much money involved, and there's opportunities elsewhere as well. And for reasons of diversification, there's also a need today for the Australian supers to diversify away from Australia. Nothing wrong with the Australian property market, but there's more to invest elsewhere as well. So Aware started off in Europe in 21 with their first investment into Europe, done from Sydney, but also recognized that if they wanted to grow the portfolio, they needed presence, local presence. So the office for Aware Super, the first international office, opened up in 23. Damien Webb, head of international and deputy CIO, came over from Sydney with a few of the Sydney team as well to build our presence here in London for private equity, infrastructure and real estate. And I was asked to build the property team as well as build the portfolio. So that's where we are today.
This podcast is powered by Rockborn. We help real estate funds, owners, investors, and developers hire better quality leadership talent. So, if you're open to trying a different recruitment approach, head to rockborn.com for more information. Can you give me just a bit of insight in terms of the size and scale from a numeric perspective in terms of the billions and the size and scale of Aware Super?
Yeah, sure. So Aware Super today is over the 200 billion Aussie dollar in total AUM. And we invest around 7% into real estate. So a decent allocation, of course. And our European portfolio today is around the 2 billion in pounds.
So quick podcast maths here, around 30 billion or so real estate AUM in Europe, 2 billion, but the plan is to kind of expand and grow that further.
Yeah, we're definitely going to grow it further. And we've been building this presence now for, close to 5 years. And with our local presence here, we have a very good setup. I've been growing the team to 7 today, and we're still growing the team. And we can manage our portfolio and expand our portfolio from here as well.
And can you just talk to me about the team, the size, the scale, and also just of the 2 billion, how you've been able to access the market and who you've done that with?
Yeah, so the full story to this, and a lot of credit in that sense to the global property team that started building the portfolio from Sydney, which is not easy. And also through COVID times, having to invest, of course, in Europe is challenging. But they managed to do a few great investments already before we even opened up the office. We started off in hospitality, with an investment in a new platform that started off in the Netherlands and has expanded into London, into Dublin, into Lisbon. It's the July, our apart hotel platform, which we today fully own and control and are growing. So a example of a platform investment, how we refer to it. So a combination of not just assets, but also everything that's needed to manage the portfolio. So we have all staff included in the platform as well. We've been growing that over the years since the initial investment, and we'll continue to grow that platform as well. Another investment that was done from Sydney in the early days was in Spanish residential, where we own, together with APG, the Dutch investor, we both own 50% in Vivenio, a Spanish residential platform. Again, done a few years ago already, when Spain maybe wasn't that high on everybody's priority list already. And we're very happy that we've been early investing in such a platform. It's one of the large residential platforms out there in Spain, and we continue to grow it as well. Another one that we all know here in the UK is Get Living, which we are invested, again, a platform investment. So it comes with complexity as well. But we believe it is the right way for us to access build to rent in the UK. We need to have the machine, say, the people to manage this in an efficient way, to manage build to rent in an efficient way. It also has seen developments, of course, come to stabilization. And for that, you need a lot of expertise as well. So that's our residential exposure today in the UK. Now, I think 1.5 years ago, so since that we opened up the office and we've been closer to the market, we recognize that if you look at our current global portfolio and our exposure to offices as well as retail, we're deliberately reduced very early on already, started reducing office exposure and retail exposure almost already 10 years ago. Reduced the exposure because we felt at the time that the tailwind was really there for beds and sheds. We've really benefited in terms of performance from that allocation, large allocation to residential as well as logistics. But more recently, we felt that the time was right to consider offices again within Europe and focusing on London offices, because that's where we felt that the opportunity was really there. We felt that with the return to the office, like we're here in your office, there is a good reason for people to be in the office. And the sector was definitely also for reasons punished. But we also felt that with the demand supply imbalance, particularly in London, and the fact that there was such a limited pool of capital available for offices, we felt it actually to be the right opportunity to start investing. And we partnered with Delancey, whom we feel is the right player for us to set up such a partnership. We knew them already from the Get Living, their contribution to Get Living, and their expertise. And they've been in London offices in previous cycles, and agreed with us that actually now was the time to start investing again in the London offices. So we started off investing 1.5 years ago. We've been buying in the West End and in the city over the past 18 months or so, and definitely see how rapidly rents are growing.
Really?
Rents are growing now in London offices. We see cap rates coming in. We see a lot more competition today also compared to 1.5 years ago. So we see what we had expected playing out today. So an example of trying to move early into a sector, and it's not like a new sector, right? Offices have been around for such a long time already, but also we need to recognize when it is the right time to start to bring back offices in our portfolio.
You've also just taken down a rather large retail transaction as well, which I know this podcast has been moved once before.
Sorry for that.
That is quite all right. Talk to me about your most recent deal.
Yeah, and maybe that's also something to emphasize, that we're not in this to do quick deals, right? We invest large amounts of money on behalf of our members, people who contribute to that super and want to be sure that there will be a gain from it as well. And we don't take that very lightly. So whenever we invest, it's large sums of money, and we have to be sure we're doing it in the right way. So we need a lot of conviction. First of all, like re-entering the office market. Is it the right time? Where do we reinvest? How do we reinvest? And with whom do we reinvest? That takes a lot of time. So it's never a quick one. This specific one, there was an opportunity presented to us to invest in outlet malls. We all knew that outlet malls are a very tightly held subsector within retail, which has performed exceptionally well throughout cycles. And this specific portfolio had been held by a few investors for many years already, managed by an excellent operator, McArthur Glen, first class. And there was a lot of history to these assets, and we could get comfortable with a lot of the data because it dates back to 2004. For most of these centers. So we were able to really due diligence it very well, to get comfortable with our underwrite. And in the end, we've been working on it for most of the year, really. So whoever is out there listening and wants to get into real estate to do quick deals, that's not, the way we as part of this industry operate. But we have definitely enjoyed it anyway. So now part of our portfolio, last transaction also for us, we have exposure to 4 outlet malls, 2 in Italy, Serravalle near Milan, Castel Romano, Rome, 1 in Parndorf near Vienna, Austria, and 1 in the Netherlands, Roermond, a place everybody knows, of course.
So from a kind of a top-down perspective, you'll pick the kind of the theme or the kind of the macro that you like, and then you'll go and select a partner, and you'll either work with them on a kind of a platform deal where you'll take a stake in the top co and either own it in part or in whole and provide capital for the strategy, or you'll do JVs as well.
Yeah, so everybody who knows me probably has heard me say this before, but structure follows strategy and not the other way around. So we should be led by our investment strategy first and foremost. So, and within real estate, you can think of different investment strategies again. We have a overall real estate investment strategy that is what we refer to today is a hybrid approach. So we can invest in different sectors. Of course, we need conviction in these sectors. There's probably sectors where you would see there's a lot of tailwind, like we have seen for beds and sheds in the past, say 10 years. But there's also opportunities that arise, and that might be shorter lived, which is also fine. We really want to ensure that we outperform in terms of returns, so we can hold on to assets for longer. But if it's a shorter horizon of, say, 5 years, that's also fine. But we try to think of sensible strategies that make sense to add to our portfolio. So once we have, decided, okay, what is the right strategy, in what geography and in what sector to pursue, we go out and try to find, a partner, because we always need a partner.
You always invest with a partner.
We always, meaning that if we invest in a platform, I regard the platform as our partner in that sense. So identifying the right platform, whether it's here in the UK with a Get Living or Vivenio in Spain, of course, we need to identify then the right platform as the right way to deliver on our strategy. But it doesn't always have to be a platform. Like with our London office strategy, the partner is Delancey, and we have set up a JV, a partnership together with Delancey, and started off screening the market and investing in London offices. So yes, we do need a partner. We need, although we're present here in London, we don't have boots on the ground in each geography in which we are invested. So we need local presence as well.
And there's no aspiration to kind of bring that in-house, so you're vertically integrated?
No, not today. I don't see the need for it either, because it's already a great addition that we have presence here in London, and from London it's easy to get anywhere. We recognize the need for a local partner, or a partner that's present in a geography in which we are not, but we don't have to be in that market ourselves.
So what do you look for in the partners that you select?
Yeah, so I truly believe, you're looking for a real partner, and I'll get to the different aspects of it. But I think what is also important to understand for anybody in this industry is that, we look for a partner, and it's also a process of getting to know somebody really, really well. And, you as if you fall in love with somebody, right? Frustrating bit of this often is that you start to like your partner, even though you haven't signed up with each other yet. And you spend a lot of time discussing with this love partner, how can we get rid of you again in the future? And so there's a lot of time and effort spent on how we divorce again, even though we really, really like each other. Otherwise, we wouldn't be talking to each other. But it is an important aspect. And we always look to the exit, really, of the investment. And very often, of course, you're very much aligned in that sense that you start a journey, or you intend to start a journey, and you both want to exit and end that journey. But it can also be an investment whereby you don't have a set time already where you will be ending that journey, and still you feel like, okay, I like to get into it, but how do I get out again? You don't want it to be a Hotel California. So what is important in a partner? You want to be aligned. You want to have a shared thinking, a shared belief. You feel you want to be convinced they have the right expertise, the right skills, the motivated people. One of the most important factors, I would say, the motivation of the people who will be on this. Are they all aligned as well? Would love to see the people being part of the journey, and also ideally be invested really and be rewarded for the performance. So we spend a lot of time in trying to align all of that, that the incentives are definitely right and the setup is right for them to deliver. We need to trust them with our money. And I feel we're doing a great job in that, but we do a lot on our due diligence, of course, to be convinced that it is right, and that the assets in which we are investing, of course, are the right assets as well.
So it takes a long time for you to kind of court and understand and appraise the partners that you would work with, but also you're very clear in terms of what the divorce arrangements would look like in the good times, but also if things don't go as well, or things that are outside of your control, what the exit would be for both parties too.
Yeah, and that's an exit of partner potentially, but also the exiting assets, like in who's going to buy this for me? We know we're going to sell. We know we're going to be sellers. We're investors today, but we're going to, and buyers, but we're going to be sellers as well. And who will be out there? And we need, we are a long-term investor, yes. So we don't feel we should be able to create huge amounts of liquidity overnight. But as a super, actually, we do have to be able to provide liquidity to our members. Coming back to, the difference also of a super compared to some other systems out there. Within a super, and our members, they're able to change from the one super to the other super overnight. That
as in like ability to move their pension pot from, say, an Aware super to an Australian super or another super.
Yeah, there is that flexibility in that system. Now, members probably don't feel that need or that urge to be changing from the one to the other if you deliver, right? So we are set up to deliver and to outperform. So we prevent them from changing, hopefully. But they are able to change, and that puts pressure on us to really, to really do our best and to outperform. It also we need to have liquidity in the portfolio. Now, typically, we're in private real estate here, so we're not the ones, the first resort to look for liquidity. But of course, we also want to be sure that we're always able to create liquidity if needed.
How do you balance kind of risk profiles of kind of development versus standing stock and those kind of liquidity windows when you're kind of constructing a broad portfolio and an allocation to a region as well?
Yeah, so I like to think of it that, whatever we buy, we should know, okay, who's going to be buying from us. Whether it's probably not going to happen tomorrow, but somewhere in the future. So are there pockets of liquidity within the portfolio? Well, coming back to the London office example, if we feel, we're buying assets that have maybe we buy offices that are liquid in that sense. We've been buying between assets in value between 100 and 150 million. There is a decent market. If we would be selling tomorrow, we probably are able to sell. If you buy an asset of 500 million, there's a limited pool of investors that is able to buy assets like that. So we try to ensure that by buying the right assets, there's liquidity. If we buy a share in a platform, we recognize, of course, that's not something you easily sell overnight. So we try to build within our portfolio to construct it such there's always some liquidity somewhere. Not necessarily for reasons for this one member, of course. It's more that makes sense to allow for sufficient liquidity in the portfolio, because there could be other opportunities out there. And if you want to capture a new opportunity and you have to look for equity within your own portfolio, we should be able to find that liquidity as well.
So you're not set into kind of 3, 5, 7 year type private equity close-ended vehicles. You've got quite flexible long-term capital that you can take a very long-term view on, but you can also be in and out of deals as appropriate on a risk-adjusted basis that make sense or fit the wider portfolio construct and structure that you're looking to kind of framework, I guess, work within.
Yeah, we are a long-term investor, but I don't feel every investment is necessarily made for the long term. So there are certain strategies that we pursue that are more tactical and where we recognize, okay, but this will probably be more like 5 years than it will be 10 years. Certain strategies you can set up because you believe the time is right now. We're going to have to develop. It will take time to develop. It will take time to stabilize assets, but probably 7 years should be enough for that. So creating a portfolio, developing assets, stabilizing them, and selling them over a 7-year period is probably possible. So a combination of strategies that will probably last for 10 years or maybe even longer, which is fine, with more liquid assets for 5 years and some other strategies that will last 7 years. But we don't commit to, say, a fund together with other LPs that is then indeed focused on the 7-year horizon. And in 7 years' time, we have to come to a shared view with the other LPs. Do we still all agree? We tend to stay away from fund investments. The other side of the spectrum, platform investments. So the private equity style of investment into platforms is what we do. We have expanded that into partnerships, joint ventures, but we do stay away from fund investments because we feel we don't have sufficient control over these funds to really dictate the direction of travel. And we don't expect us with a minority share to really dictate at all. We just want to make sure that we have, the right say over the important decisions. We can do so with a minority share in a platform where we feel we are aligned with other investors and we have sufficient control over the whole operation of the portfolio, as well as in partnerships where we feel, okay, with our partner, we dominate and we have the right governance.
So what metrics do you appraise deals based off?
So we do apply our minimum required return model, I would say. So every geography requires a different return. And then there's a build-up in terms of, country, sector exposure. So the one sector requires a higher risk premium than the other sector. Investing into core assets, as in stabilized, requires a lower return again than developments. So it's a real build-up of risk premium to arrive at our required return. We do also look at the total return in the sense, is this really adding something to the portfolio? Are we going to add outperformance with this investment? Coming back to our members again, we want to outperform for our members. So it's not just looking for diversification per se. We want to ensure that we deliver and that we outperform. So that build-up of our required return, we compare every investment opportunity with our minimum required return in order for us to present something as a real opportunity to our investment committee.
And do you have a certain allocation that you have to get out of the door every single year, or is it just based on being smart and sophisticated and performing and doing the right types of deals for your your kind of members?
Well, we're not pushed to do any investments if we don't believe this is the right time to invest. There is an allocation of say 7%, but there's definitely also a possibility for us to be underweight or slightly overweight at the same time as well. Now, of course, if you want to be overweight, you have to make the case, I'd say, and we could, present a case to an IC, but one of the other asset classes could also present. So then it makes sense, right? That if we want to get to an overweight position, we have to demonstrate that actually that is the best way to do it and not invest it in any of the other asset classes. But yes, so that is, say, that portfolio approach is done.
What's your view on the UK and the European market? If you kind of take a bit of a kind of step back, there's been a lot of talk around structural and cyclical changes. How do you see things?
Well, I think if you take a step back, we've had some difficult years within the European, or globally, I would say, in real estate. With interest rates hiking, of course, real estate has been punished. I feel there is a real opportunity today, and we don't all have to rush. I'm happy that, over the past 1.5 years in which we have been, really investing within the European market, I was happy there was actually limited competition. We've benefited from that, I feel, limited competition. It makes sense for more core money to also return to the market, I feel. Debt markets have been very healthy. We've seen on investments we have made recently, there's a lot of debt available. So margins on that side are under pressure. And I think more and more people recognize that on the equity side, there's an opportunity to start to increase their investments into real estate. So we are going to continue our growth in that sense, looking to add investments where we in our portfolio maybe have blanks and where we see opportunities. We don't have to fill all the blanks, don't get me wrong, but we see, for example, an opportunity for our portfolio in a geography like Germany. We don't have any exposure within Germany. We do feel there are opportunities in Germany. We don't have any exposure to the Nordics or in France, so we definitely will consider opportunities in these geographies as well.
Talk to me about the team that you've assembled and how you've thought about building a high-performing team as well.
Yeah. So for Aware, and I definitely share that, it's very important that culturally we are very much aligned to the culture that has been built within Aware in Australia. So also with my, when I was hired and brought in, that was very much emphasized. Now, I don't have any Australian background, right? But there is a recognition that we want to cherish the Aware culture. And I definitely buy into that. And what has been really helpful is that also in my team, I have 2 people that have been seconded from Sydney to UK. They love being here, but they're also real culture carriers of the Aware superculture and the Australian culture as well. So it's great to have people that know the mothership really, really well. Has definitely helped us as a property team to build up our relations with the headquarters, and not just the property team, but also all the other functions we need to really perform in the UK as well. So very important that link has been with us from the start. We've been hiring locally from different sides of the business, from GP as well as, well, mostly GP side, I would say. So to bring in that knowledge and really and the deployment of capital in throughout Europe as well. A diverse team, really important. I really enjoy being with them every day. We are in the office almost throughout the week. I also enjoy the team being, fairly young, I would say, definitely younger than I am. But we've been building up. It's a good mix today in terms of expertise, skill, and a number of years of experience they bring and exposure they have had through different sectors, through and from different backgrounds. Now, what I find really important and what I've also done in my career is make sure you continue to educate yourself, not just on the job, but also continue to learn. Like I did my master's, during my career, maybe not an advice because it's quite difficult to do it while you're on the job, but still look for opportunities, look to grow your knowledge during the day job, but also look to educate yourself further throughout your career. And what I really enjoy is the people within the property team, but throughout the London office within Aware, they're also keen to learn and willing to put a lot of long hours into really build a reputation for Aware Super here in Europe. We are new as Aware Super within Europe, and it takes a long time to build a reputation. You can easily, go wrong in it as well, but we really, really put a lot of effort in, building a sound reputation for Aware in Europe.
Is there a belief that you held very, very strongly around real estate investment or allocation that you've recently changed your mind on and no longer believe to be true?
It's not really something I don't believe anymore, but it's more, I'm very much aware that there is a time to buy, but also a time to sell. So don't fall in love with your assets is something I have also learned in my career that, it's going to hurt you if you hold on to an asset too long. And no matter how much you like an asset, the asset can tank. And you can't blame the asset for it, but it's the markets that change, and you can lose a lot of money by holding on to an asset for too long. So whether it's about timing it well or taking your losses earlier rather than later, just stay focused on not just when to buy, but also when is the right time to be selling.
Mathieu, if I gave you £500 million worth of capital, how would you allocate it?
Yeah, I'm glad you warned me about this question. This is not going to be an investment advice, right? As in how you're going to best allocate to certain markets. What I would be really passionate about is to invest that in, it's going to be a combination of land and buildings, definitely real estate related or real asset related. I would say let's invest 500 million in 5 different projects all over the world, rewilding in combination with real estate. So restore nature where it is needed, whether that's in Scotland or elsewhere in Europe or elsewhere, in the world. But initiate 5 different projects, 100 million each, ensure that we do it in such a way that income is generated through real estate, probably, that we can continue that journey and improve nature in these 5 different places with local people, in terms of how we're going to do it, with local people involved, and use them as the real, contributors to these projects, and ensure that we can then expand that in other projects, places, globally as well.
So real estate and natural capital, kind of that blend, bringing them together under a badge of real assets to drive income but also appreciation and wider total returns as well.
Yeah.
Thank you so much for joining me in the podcast today. It's been fascinating to hear a little bit about your background journey and also understand a bit about the kind of the culture, the view, the mindset of Aware Super, how you access the market, what you look for in partners and what the plans are moving forward. So thank you so much.
Thank you, Matt. Thanks for having me.
If you enjoyed this week's episode, do me a favor and send it to a friend or colleague. And if you've got any guest recommendations, hit me up on LinkedIn. I would love to hear from you. Hope to see you next week.